Hello and welcome to Africa Business Weekly, your one-stop shop to everything business in Africa. I'm Aki Obakeye. Better late than never, as some of the big economies on the continent rolled out their budget plans for 2025. Today's show promises to be packed with content from West, East and Southern Africa. Tabitha and Karabo are with me to take you on this engaging show. But let's join Tabitha for updates from the east of the continent.
Thank you, Akin. From the east, we bring you dynamic market shifts as the latest Africa Financial Industry Barometer paints a stark picture of the continent's financial sector. The sector's attractiveness is declining amid unprecedented geopolitical shifts. CNBC Africa's Abiagina spoke with Patrick Njoroge, the AFIS Advisory Board Chair and Kenya's immediate former central bank governor, for deeper insights.
It's interesting that respondents expressed confidence in the economic prospects of their organizations. And this is obviously the financial sector, the financial sector, the elements of the associations, the organizations that they are in the financial sector. Interestingly, fintechs were the most optimistic, and capital markets were much more cautious. So, and everyone else, banks, etc., insurance companies were more or less in there. Secondly, in terms of the economic issues that, let's say, respondents felt most pressing, the big one was inflation. And this was really their dominant concern more than other factors or other issues like political instability, cybersecurity, talent scarcity, climate risk, etc. That to me was quite surprising because it pointed to macro stability as something that is of significant concern for respondents. Thirdly, the industry, the attractiveness of the financial sector. The perception of respondents is that this has fallen, meaning the attractiveness has worsened, and the industry is less attractive for international, or should we say local investors as well. 2/3 of the respondents believed that the sector had stagnated or declined, and this definitely has worsened relative to the past, and something that is of concern. It's pointed to, or it was due to things like geopolitical stability, security, and the other matters that were going on in the global space. Another point which I thought was interesting was that respondents saw digitalization as the short-term priority in all the sub-sectors in the financial sector. So the digital journey is very important. However, surprisingly, I thought, only 2% of respondents indicated that they had deployed an AI, artificial intelligence project, which is something that shows we have some ways to go in terms of growth in this space. Also, another point which I thought was important was the perceptions about the ongoing initiatives towards integrating Africa, both economic and financial integration. And most were, for instance, in the various projects like the payments platform, PAPs, etc. Only 44% of respondents saw this as significant. So in some sense, they have cooled off in terms of what they viewed, their view about this being very significant. But there is also another project which is less ready, meaning has just started on the foreign exchange transactions, etc. And that they thought was much more significant to them. 62% of respondents thought that was significant. Two other points before I finish. Again, highlighting the findings, the important findings of this survey. On governance, the survey showed, or respondents showed, that this has strengthened at the board level, especially with regard to implementing the various committees, audit committees, risks, etc., risks and other risk and oversight, etc. And at the same time, something like 39% of respondents indicated that in their own association, in their own organizations, they have independent directors. So, which is an improvement from the past. So, an increase in the number of independent directors, and only 18% of boards still lack independent directors. So there's improvement in governance in that space.
3 years ago, the Pan-African Payment and Settlement System was launched to streamline cross-border payments and boost ACFTA trade by eliminating third-party platforms, currency conversions, and reducing time delays. We spoke to CEO Mike Ogbalu about how the technology navigates its reliance on pre-funded models and more.
It was designed to bring together a number of ecosystem players, from the regulators to the commercial banks to other payment service providers. And it's also designed to shorten the lengthy models where we depended on third-party global correspondent banks. So you talked about liquidity. We've designed PAPS in such a way that it actually reduces the liquidity requirements for cross-border transactions because it's based on a multilateral net settlement model. The current payment systems require commercial banks and stakeholders to actually depend on third-party global currencies in such a way that it actually constrains trade because they don't have enough to facilitate trade.
Right.
What PAPS does is allows those transactions to originate in their local currencies and actually terminate in local currencies. So, for example, if we were doing an equivalent of, say, $5 million worth of Naira and $5 million worth of Kenyan shillings going from Kenya into Nigeria, then both transactions settle all in local currencies without any need for any third-party global currency.
Right.
However, if there is any net difference, then that net difference is settled in an agreed third-party currency. So what you have is you have a substantial reduction in dependence in any third-party currencies, and therefore the liquidity that will be required to facilitate trade across the continent will be significantly reduced.
Certainly, the elimination of a third party for these transactions has been the key, the game changer of this entire system. But going back to the concept of net settlement model that is being utilized, does it carry a risk of imbalances? Looking at the currency volatility and exchange rate fluctuations, does it carry that risk?
Well, it doesn't enhance any risk. What it does is to reduce and to a large extent eliminate some of those risks. So what happens now today is that those imbalances exist, and most of those imbalances are looked at from the point of view of bilateral relationships. So you can look at between South Africa and Zimbabwe. But operating a model that is multilateral net settlement means that it can go beyond just bilateral relationships and look at flows, considering all of their relationships across the entire continent. In that way, you find that those imbalances you talk about actually substantially reduced. So if between Nigeria and Ghana, there's a deficit of about, say, 15–20%, by the time you consider other countries that trade with both countries, it actually reduces the net position substantially because you have factored other flows outside of just that bilateral relationship. So PAPS actually significantly puts these countries in a much better position and for them to have more effects to be able to do other things. And remember that this system is not designed to isolate Africa from the rest of the world.
Right.
If we're able to lower the amount of third-party global currencies that they require for intra-Africa trade substantially, then they will have more to be able to support their trade with the rest of the world.
Wonderful. Now, does this bilateral relation model also play into solving the issues around regulatory and compliance mechanisms? Because we're talking about so many different countries with varying capital controls, with varied regulations. So how is PAPS addressing those challenges, or does the model itself take care of it?
So we can look at it from a number of perspectives, starting first of all with making sure that what we have built at PAPS meets with global standards in terms of AML, sanctions screening, and management of fraud. What we've done is we've built a system that aligns with the principles for financial market infrastructure.
As Africa's financial landscape evolves, innovation and strategic partnerships remain key to driving growth. Curtains close on East. Back to you again.
Innovation and strategic partnerships are the bedrock for driving Africa's growth. Apt. But let's switch gears now to the southern part of the continent with Karabo Mashaba.
Well, thank you, Akin. Well, second time proved to be the charm as South Africa's finance minister finally tabled the national budget 3 weeks later than originally intended. My colleague Godfrey Matizwa spoke to a panel of experts to unpack the country's first budget speech under the National Unity Government. This included Mzimasi Mabece, who is the head of fixed income at Melville Douglas, along with Kuligani Mathe, CEO at Business Unity South Africa, and last but not least, it's Zanga Mukumba, who is a tax associate at Baker McKenzie. Let's listen in.
I think in the context of what the minister was dealing with and trying to balance the book, I think it makes sense, and I think it sort of eases the pain, as it were. But I think, as I have said, the fact that we've had to come to the point where raising taxes is what we're looking at suggests that over time, we have let ourselves down as a country. And this is why we're here.
Yeah, I'm remembering I was talking to a friend of mine and he was saying, well, the minister's got a variety of options in front of him. One, of course, is the easy one, which is the VAT one. And then, of course, you could have raised other taxes as well, or you could have gone and borrowed, or you could have done the big deed and cut spending. We'll come back and talk about that. Let's bring in the other voices in the conversation. Tsanga, let me come to you. I think we all were waiting. Was it going to be 2 percentage points? Was it going to be 1 percentage point or just 0.5 percentage point? When the 1 percentage point over 2 years came through from a tax perspective, was that the easier option for the minister?
Definitely. I think the minister had a tough call to make. He needs to find the money somewhere. Cutting expenditure in the current environment where we've had fiscal consolidation for the past, since 2020 approximately, would be a difficult thing to do. So yeah, it was the most palatable option that he was faced with at the moment.
We all fixated, of course, on that 1 percentage point. Yes, half a percentage point this year, another half a percentage point next year. If indeed the economy does not grow fast enough, I think that was the caveat that it put in place. I did see someone suggesting that the presumptions that the minister is making are also a little bit problematic, and it leaves him with very little room for error. I want your comment on that. That's one side. The other side I wanted to talk about is that consolidation story that you spoke about. I want the evidence of it.
Sure. So on the consolidation point, there has been an increase in expenditure, sure, consistent track since the consolidation measures were put in place. But I think the key difference is the zero-based budgeting, where we have to build and justify every rand that we are allocated. It kind of changes the approach and the mentality that comes with the budgeting process and the expenditure itself.
And in addition to that, of course, this wasn't just one tax that was increased. We stuck on that one. But what about the other taxes, the usuals?
Definitely. So we saw excise taxes increased. I personally thought that was low-hanging fruit for the minister and that he would hit us with a well above.
7%, right? Let's not call 6.8%, 7%. And you say low-hanging fruit.
Definitely, because it's the most politically acceptable. It's you're not going to ruffle too many feathers when you tax luxury yachts and expensive whiskey a little bit more. So, yeah.
Yeah, I think we're all doing the calculations. We're all doing the calculations. Zumas, let me come to you. Your initial impressions, as I said, I think the minister had a variety of options, one of which could have been increased borrowings, but he did announce a few initiatives, including the launch of that, or the coming of the first infrastructure bond. But let me get your initial reaction.
Look, I think we can all agree around this table that indeed this was a very difficult budget to put, and I dare say very contested
10 parties
budget to put in place. But having said so, we are currently borrowing at 10.5%, and this economy is growing nominally at 4.5% at best. So obviously, it is no wonder our interest cost is about 22 cents for every R1. So to borrow more in this environment, I think it would be suicidal. And what we saw in this budget, we saw that he did not increase the borrowing. But the only thing that he did, which I think is positive, is that he is introducing an infrastructural bond.
Yes.
And that is meant for one thing and one thing only. Infrastructure. And as the president had said in his State of the Nation address, that to unlock the levers of this economy, we need to do that through infrastructure.
And in more news driving the Southern African region, mining group Exxaro has moved to draw a line under its recent boardroom fallout with its former CEO by appointing industry veteran Ben Magara as her successor. He starts next month. Exxaro also released its annual results, reporting a 36% slump in profits in the year to December 2024 amid weaker coal prices and spiraling logistics costs. For more, CNBC Africa's Fifi Peters spoke to Rian Koppershaw, who is an acting CEO and finance director at Exxaro. Let's listen in.
The appointment of the CEO was a board matter, so I can't now pronounce on that. But I can just say we're very glad that Mr. Garo will join the company. He's been a veteran in the mining industry for many years. He brings a wealth of experience from the coal industry, from his days as CEO at Lonmin. Also, remember, he's also in the Exxaro board, so he knows the company inside and out. So very privileged, and everybody looking forward to work with him.
So, I mean, it was an expedited process. You, as the group, wanted to restore stability, it would seem, in the C-suite as soon as possible. But can you just maybe help us understand exactly how this fast-track process to get a permanent CEO went, and who the other candidates the board considered were?
Look, I'm now not privy to that information. As I say, the appointment of a CEO is a board matter, so I'm not in a position to comment exactly how that process unfolded.
Okay. No, we'll respect the terms then of what you can and cannot say. Perhaps let's just talk about your numbers in this period then under review. It's not the best performance you would agree or disagree that Exxaro has put forward. Maybe just take us through some of the most pressing pain points that did place such a huge dent on your bottom line, and what the situation is looking like right now, 3 months post your year end.
Yes. So if we look at the results, you must see it in the context of commodity prices coming down. So commodity prices in the coal sector came down, as well as also iron ore, where we've got a 20% interest in Sishen iron ore. Then we still continue to suffer on the logistics front. We're not able to move all our products to the customers, and then also reduced offtake domestically from our largest customer, Eskom. So I think if you put all of that into the mix, that impacted our performance adversely.
And so as we talk about what the year ahead does look like, I mean, just noting all the factors that you've mentioned, I'm just curious as to how many of them are still with you now, and how the management right now and even the board is thinking of ensuring that there isn't a repeat such that you do report a similar decline in profits in the year ahead.
So we are seeing positive signs. We're fairly hopeful that on the logistics front, the TFR volumes will increase. We started seeing increase in volumes towards the end of last year. And then also on Eskom, on the offtake side, at Medupi, we know Unit 4 is coming back into production. So that will also assist us on the volume side.
And those were the news making headlines down south of the continent for this week. It's back to you, Akin.
The Ghanaian government says it is committed to the pursuit of its 24-hour economy policy aimed at stimulating economic growth and job creation. At the 2025 budget presentation to Parliament, Finance Minister Kassi Ato-Forson explains that the government targets a lower budget deficit this year to fix the economy after the debt restructuring. Richmond Freepong Advisory Board Chair at FLF Africa unpacked the government spending plans and other fiscal policy initiatives. Take a listen.
The first budget, it appears the highlights on the economic restructuring and also the stabilization of the forex situation, and largely the macro handles appear to be a good step in terms of the highlights they are using this budget to focus on. It's early days yet. Even if you look at their projections in terms of GDP growth, it tells you that they are being cautiously optimistic in terms of the expectation. Why? Because the year end of 2024 was looking at a gap of about 5.7, but they took cue from last quarter, which dipped a bit to about 3.6, and they are now looking at about 4.4, 4.6, 4.7. That means they are being cautious, and that is a good try, at least for the first budget.
And talking about the first budget now, I'd also like your take on the breakdown of the budget details at this moment now, looking at how much has been earmarked for domestic debt service and also on the back of the IMF debt program we have at this moment. Your take around the strategy here and the allocations. When we also look at some of the case scenarios being mentioned by the finance minister for debt service, for example, the years 2027 and 2028 being major humps, but it says these will be fixed. But the challenge is near term as well. 2025, 2026, we still have a similar scenario. So the country is not really out of the woods yet. Your take around budget deficit, the flows from the World Bank, IMF, how much caution should the country exercise at this moment? And in terms of fiscal consolidation, how much more can we attain?
Right. It appears at this moment, if you look at the projects and the programs still under a fund program, there is very little they can do in terms of fiscal consolidation. What is in their ability, or what they have a lot of control over, is about the expense side or the revenue allocation side. So they have to do a lot of mobilization, but in allocating, they are looking at creating a lot more fiscal space. In terms of the debt hangovers, there is very little they can do, because any default can also trigger a difficulty to go back into the program and to assess the funds they are looking for, and even to access the capital markets. So in terms of effort, there is very little they can do on the fiscal side. And you can tell from the pointers, they are going to be consistent and follow through on the debt payables, but they are also going to be cutting down on critical expenses. You see that they've thrown out of government and its fiscal policy most of the programs that were going to be a snare on the expenses. And they have now consolidated some of the critical expenses that will be into the productive sectors of the economy. So in that sense, I would say they are good to go.
Nigeria's Minister of Art, Culture and the Creative Economy, Anatu Musawa, says the Lagos Arena project, designed to be the global home for Afrobeats to project Nigerian music and pool investment, will be delivered in the next 18 months. She highlights a 5-year timeline for the Abuja Creative City, while stating that stakeholders' engagements have been completed on an intellectual property policy, which will be delivered as soon as the Federal Executive Council meets.
International Women's Day, for me, this year, we're talking about acceleration, you know. it's very germane for us to speak to that now at a time where, you know, women at some point started making a lot of progress, but then you can see that there was a little bit of a shift whereby there was some interruption in the progress of women. So I think it's very important for us to make that push again so that women know that there is an equal opportunity for them. And that's really what this Women's Day means for me, is really about giving women that platform that will give them the equal opportunity as men have to be able to, you know, realize their full potential.
No doubt, equalizing opportunity in a society like Nigeria will definitely go a long way for the women folk here. But I'd like to speak to the high hopes the government has for the creative industry. I see that the government is quite ambitious in terms of what this sector could add to the GDP. We're seeing likely $100 billion. Probably the government is targeting an increase of about $100 billion to GDP from the creative sector. I'm trying to imagine how this is going to happen and speak to some of the creative investment the government is looking at.
Well, you know, from the very beginning, President Bola Ahmed Tinubu, you know, wanted to do a diversification strategy. And you wouldn't believe it, but for the first time in Nigeria, this is the first ministry that has catered to the creative industry. Before now, there has never been, government has really never been interested in doing this handshake with the creative industry. And, you know, it was a real low-hanging fruit, as you would expect, because in terms of what Nigerians are doing, the successes that are coming out of the creative industry, especially in Africa, you know, Nigeria is at the top. When you talk about the music, when you talk about the movies, the fashion, even the gastronomy with our jollof rice, and it's so much, the content, the artifacts, there's just so much that comes out of Nigeria. But government, up until now, didn't really give an opportunity for itself to even lay foundations that will allow the industry to grow. So when President Bola Ahmed Tinubu did this diversification, and he asked us to look at how we can leverage on what Nigerians have done and what we have, the different sort of content we have in the country, this diversity that we have, how we can tap into that to bring a source of economic growth.
And that's all we can bring to you this week. Make it a date with us same time next week. I'm Akin Obake. Have a fabulous week.